Hi friends, it's Kallie Orr, your Northern California Realtor and real estate bestie. Today we're diving into something I get asked about all the time, investing in real estate. Whether you're brand new and curious about where to start, or you've been thinking about it but haven't pulled the trigger, this video is for you. We're going to talk about buying a rental property versus flipping, and understanding cash flow and return on investment, and what really makes a great investment property. So let's get into it. When people think of investing in real estate, two strategies usually come to mind: rentals or flipping. Let's explore the differences and what to expect. Rental properties are typically a long-term strategy. You buy a home, rent it out, and collect monthly income. You build equity over time, you may generate consistent cash flow, and there are potential tax benefits. But real talk, especially in today's market, your rental may not immediately turn a profit. In some cases, you may break even at best, particularly in the beginning, and that's okay. Breaking even while someone else pays down your mortgage means you're still building equity and long-term wealth. You also have to factor in things like maintenance, vacancies, and tenant management. This is where a good property manager can be a game changer. If you don't want to deal with calls at 2 a.m. about a leaky faucet, you can outsource the day-to-day to a management company that handles tenant screening, rent collections, repairs, and more, for a fee, of course. Flipping, on the other hand, is more of a short-term hands-on approach. You buy a property, usually one that needs some or a lot of TLC, fix it up, and sell it for a profit. You could make a large profit relatively quickly, no tenants or long-term maintenance once it's sold, but it's risky. You need strong market knowledge, a solid renovation budget, a reliable contractor team, and good timing. One surprise behind the walls or a delay in construction and your profit margin can disappear fast. So, which one's right for you? If you like long-term steady income and want to grow wealth over time, rentals could be your lane. If you're more hands-on, love design, and are okay with risks for a quick return, flipping might be your thing. Let's talk numbers, because real estate investing is all about the math. Cash flow is what's left after all your expenses are paid. Take your rental income and subtract mortgage, property taxes, insurance, maintenance, management fees. Positive cash flow equals money in your pocket each month. Negative cash flow means you're paying out of pocket. Your goal is sustainability. Positive cash flow, even if it's only a few $100s a month, adds up. And again, you're building equity. Now let's talk about ROI, return on investment. It's how much profit you're making based on what you've invested. For example, if you put $50,000 into a rental, including down payment, closing costs, and updates, and your net income is $6,000 a year, your return on investment is 12%. That's a strong return. You'll also hear about cap rate, your property's annual net income divided by the total value. It helps you compare one investment to another. Pro tip, always run the numbers conservatively, plan for vacancies, budget for surprise repairs. Don't bank on appreciation alone. Make sure the deal works today as is. So what makes a property a good investment? Here's what I look for. Number one, location, location, location. Look for areas with low vacancy rates, good access to schools, jobs, and public transportation, signs of growth or revitalization. Number two, the numbers have to work. Don't get emotionally attached to the home. Fall in love with the math. If numbers don't work, walk away. There will always be another opportunity. Third thing to look at, property condition. You don't need a full-blown fixer-upper, unless that's your thing. A light cosmetic upgrade, paint, new floors, kitchen refresh, can go a long way in boosting returns. Number four, we want to look at value add potential. Can you convert a garage into an ADU? Raise the rent after some upgrades? Refinance once improvements are made? Opportunities to increase income or reduce expenses equal better returns. The fifth thing we need to check is tenant demand. Make sure people actually want to live there. Check rental listings. If things are getting leased quickly, that's a good sign. Let's go ahead and recap. You've got two main paths: rentals for long-term wealth, or flipping for short-term gains. Know your cash flow and your ROI. They're your decision-making anchors. And focus on strong numbers, location, and demand when picking a property. Real estate can be one of the most powerful ways to build wealth if you go in educated and prepared. If you're thinking about investing and want help running the numbers or finding the right property in Northern California, especially Sacramento, Placer, or El Dorado counties, I'd love to help you. It's my thing. Let's connect. Send me a message, drop a comment, or visit KallieSellsRealty.com. Thanks for hanging out with me today. Don't forget to like, subscribe, and share if this was helpful. I'll see you in the next video. Bye!